What in the world is going on with the reverse repo facility at the Federal Reserve, with it currently hitting $2.3 trillion? Apart from a few brief spikes in September of 2022, we are reaching the top of the range that it's been since June of 2022. Now, if you're not familiar with the reverse repo facility is, this is where banks park their cash in order to get collateral. You see, banks have requirements to get collateral to offset their liabilities, which is deposits. And so when banks get a bunch of cash, normally they go out to the open market and they buy things like short-term government debt, like T-bills. But after the trillions of dollars that the federal government spent that was printed into existence by the Fed over the last few years, there's a lot of cash flooding into the system. So banks needed a place to go get this collateral from. So the Federal Reserve said, just get it from us. They didn't want banks going out and buying this debt off the open market because there was so much cash being used to get that collateral that it could have pushed rates negative. And now, especially as the Federal Reserve is trying to raise interest rates, they definitely don't want that $2 trillion going out to buy up government debt on the open market. That would push rates down. And keep in mind, this is the opposite of the repo market. We're talking about the reverse repo market. The repo market is where banks go to get cash. If they have a lot of collateral, they'll go to the repo market to get cash. It's literally all one big pawn shop with financial institutions trading cash and collateral with each other. And so over the last couple of years, especially as the money printing and inflation got out of control, more and more money has flooded into the reverse repo facility at the Fed. You can see this really started in April of 2021. Because from March of 2020 through April of 2021, for that entire year, the Federal Reserve had told banks they didn't have to worry about their collateral requirements. But once April of 2021 came around, suddenly banks needed to worry about their collateral requirements again. And so the reverse repo facility at the Fed is where the banks started to get it. Now, if you notice, back in April and May, there was not a whole lot of money going into the reverse repo facility. Especially historically speaking, it was well within the normal range. But something changed right here around June of 2021 when a ton of money started flooding in there and it just never stopped. And that change happened right here, which was the amount that the Federal Reserve would pay to banks on that cash. You see, before, the reverse repo facility was basically like, hey, put your cash in, we'll get you the collateral that you need, but that's about it. And in June of 2021, they made the change and said, if you give us that cash, we'll actually pay you 5 basis points, 5% of 1%. And during this time, the federal funds rate was 0%. And so that was an easy way for banks to get risk-free money from the Federal Reserve. And ever since then, every time the Federal Reserve has raised the Fed funds rate, they have also raised the interest rate they are paying into the reverse repo facility so that it is always 5 basis points above the bottom end of the federal funds target range, which means they are currently paying 4.3%, as the bottom end of the range for the Fed funds rate is 4.25%. This has kept the flood of money going into the reverse repo facility instead of going out into the open market to find collateral. Now you might say, well, yes, they're getting paid 4.3% to keep that cash at the Federal Reserve, but why wouldn't they go out and buy short-term debt anyway to get a higher rate? Well, even a 2-year at 4.36% right now is not much better, and you go further out to the 10, the 20, and the 30, and you're sitting below the reverse repo rate. Not to mention that when you buy debt from the open market, you have risk associated with it, whether it's risk of default or market risk if you have to sell that debt before maturity. So by giving their cash to the Fed in the reverse repo facility, it's literally risk-free because they're getting paid directly by the one entity that has a monopoly on printing money, the Fed. Which has led many people to ask the question, when will this stop? Because clearly there's $2 trillion or more in the reverse repo facility right now that at any moment the Federal Reserve can push out at a time they need. Literally all they would have to do is lower the rate that they're paying into the reverse repo facility, and then suddenly the risk of buying that short-term debt on the open market would be attractive enough to drain all that cash out of the reverse repo facility and go out into the open market to buy up short-term debt. The answer is they clearly don't want to do this yet, as they're still trying to fight inflation, or at the very least look like they're fighting inflation. They're draining assets off their balance sheet, which pushes interest rates up. They're also raising the federal funds rate, which also has an effect of pushing rates up across the curve. So the last thing they want to do right now is add $2 trillion of liquidity back into debt markets, pushing rates down, which would have a stimulative effect on the economy. They're trying to do the opposite right now. They're trying to crush the economy. They're trying to crush the American household. They're trying to make debt more expensive to divert more income to debt service costs so that that income can't be spent on other things that will grow the economy and raise prices. Now, because of this, many people, like myself included, have said that the initial sign of a soft pivot will be once the reverse repo facility starts to get drained. Once this chart starts to head back down, that would be a sign the Fed is allowing new liquidity to go out into the market to be some sort of a stimulus. Which means many people were watching this happen in November, at the end of November of 2022, and saying the tides had turned and now liquidity was leaving the reverse repo facility and going out into markets again. But as I made you guys aware, you have to watch for year-end changes, as quarter-end and year-end changes to the repo market always affect things, and that's exactly what's happened over the month of December. We've seen a complete reversal in that trend, and now we're back up to $2.3 trillion in the facility. Now you can see every single one of these spikes is at quarter end here, back in July of 2021, and then September of 2021, December of 2021. You always get these spikes at quarter end, and then it kind of reverts to the mean from there. And so this is definitely at least somewhat due to the year-end spike, which means that I personally completely expect the number in the reverse repo facility to go back down at least under $2.2 trillion come January. But the fact of the matter is the Federal Reserve is still raising the rate that they're paying on the cash in that reverse repo facility. And there is nothing to suggest that they are going to change that path until there's some sign of a liquidity crunch in the system, which we are very far from right now. The only other situation which I could see this changing, where the Fed pushes this $2 trillion out by lowering the rate they're paying on it, would be if the Treasury tries to auction and take on new debt, and it's just a really bad auction, and suddenly, for whatever reason, rates start to skyrocket for government debt as they aren't able to borrow for whatever reason. Now, again, given the fact that interest rates right now are close to or lower than the reverse repo rate, I don't imagine this coming up and being an issue, because if rates were to go up for government debt to, let's say, 5%, then you would have an incentive suddenly then for some of that money to leave and go buy that higher interest rate debt. So at least while inflation remains elevated, the Federal Reserve will continue to try and push rates up so that more and more income must be diverted to debt service costs, which crushes demand. And until that ends, I don't see the Federal Reserve actively trying to push money out of the reverse repo facility. But when they do, that will be the first sign of a large-scale pivot. And finally, I will be speaking at Jason Hartman's Empowered Investor Live Conference. It's going to be in Scottsdale, Arizona on January 27th through 29th. I would love to see you there. It's going to be a great event with a bunch of great speakers. Get your ticket with the link in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.